The incredible importance of dividend investing. It looks pretty good. All right, so this is, I've been thinking about this a lot, especially with the market chaos the last week or so. I'm telling you, man, this is nuts. Let's just dive into this. So basically what we're doing here, it's nuts. All right, what we're doing, we got two things here. We got the S&P 500. Looks like this all tangled up. All right, S&P 500 on the right-hand side. We got the 10-year Treasury on the left. I'm not comparing these in terms of investment, what has done better investment-wise. I'm actually comparing it solely to income from dividends. I think it's incredibly important to not undervalue dividends, especially when the markets are falling off. And I'll show you why. All right, so we're going from 2010 to 2019. If memory serves, or if my math is right, and I need my calculator, or I'm just going to count these. We got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 years. Then we'll go into a question mark for 2020 because I think you'll get a kick out of this. All right, starting 1 January of 2010, ending 1 January of 2019. All right, so we got 10 years in this in this time frame. We have $100,000 we can invest. We're saying we're going to invest in the 10-year Treasury, or we can invest in the S&P 500. What gives us more income? What gives us more income? And again, we're not looking at net result from leftover value after 10 years. The S&P will blow away the 10-year Treasury probably 80% of the time, if not 90% of the time. We don't even need to compare that to validate the power of dividends. But all we're doing is looking at income. So 2010 through 2019. Now remember, the markets had just fallen off a cliff. 2009 was pretty good, but the beginning of 2010, a lot of people were just like, "Whoa, I can't take it anymore. I need income, and I just don't want risk and whatnot." And they went the bad route, which would be the 10-year Treasury. So look at treasury.gov. We can see on the first trading day of 2010. The 10-year Treasury was yielding 3.85%, which I don't have up there. So let me write that, 3.85%. All right, 10-year Treasury was yielding 3.85%. All right, so that meant if we invested $100,000 in it, we're getting $3,850. That's what we were getting for an income base. So it's 3.85%, we're getting $3,850, all right? Now, the S&P 500 is a little bit different. We got to figure out a couple things here. First of all, we got to figure out how many shares will $100,000 buy. So the first trading day of 2010, the S&P 500 was at 1978. So we take our trusty calculator, 1124, excuse me, right here, 1124. So we take our trusty calculator, and we say we do $100,000 divided by the S&P 500 price at that point, 1124, and that gives us, you can see my calculator right there, 88.96 shares. 88.96 shares, all right, 88.96. Now, at the end of that, so we got 88.96 shares. We're putting $100,000 in the S&P 500. It's giving us basically 89 shares, but now we got how much is the dividend? The dividend on the S&P 500 at that point was $22.78, or $22.24. So basically, I'm saying the dividend on the Treasury yield coupon, the interest yield, however you want to do it, was $38.05. The dividend on the S&P 500 is $22.24. If that makes sense, it's all the same thing. It doesn't matter. We're basically saying we have $22.24 is the dividend yield times the number of shares that we have. And the number of shares that we have is 88.96, which gives us $1,978 of income. This really is a fake number. I just created that to show you the two things, the difference here, which will be interesting. So $3,850 from the 10-year Treasury, $1,978 from the S&P 500. I hope that makes sense. Don't get too caught up in this 38.5 thing. It's just a visualization to show you that the S&P 500 was only giving you $22.24 a share. We had 88.96 shares, which only give you $1,978 of total income. I hope that makes sense. Whereas the 10-year Treasury is giving you 3.85%, 3.85% on $100,000 is essentially 38.5, but in reality it's $3,850. So essentially we're getting twice the income on the 10-year Treasury than we were getting in the S&P 500 with a whole lot less risk. Not even going to the tax consequence either. Remember, this is taxes OI, ordinary income. This is taxes QDI, and depending on what tax bracket you're in, if you're in the 10 or 12% tax bracket, there's no taxes whatsoever. Every time, QDI is taxed more favorably than OI, every single time. So we're not even have to go in that. So I hope that makes sense. That's what I'm setting up at. So we have 88.96 shares. We're taking the income off. We're not reinvesting, taking the income off. You can't reinvest in a bond anyway. So in this case, we have $3,850 a year on our $100,000 Treasury. We know for a fact after 10 years, we're going to get our $100,000 back from the Treasury. That's guaranteed. We do not know what we're going to get here because it's based on the market conditions. All right. So the next year, this always stays at 38.5, or that's the coupon is 3.85%. This always stays at $3,850. So we know for a fact that 10-year Treasury is going to give us $38,500 in income, $3,850 times 10, and we're going to get $100,000 back. We know that for a fact. That is locked, signed, sealed, and delivered. Here, though, we have no clue. So the first year, we have 22.24. Is our dividend per share times the number of shares, 88.96. We got $1,900. The next year, the dividends went up from 22.24 to 22.96 at the same number of shares. We have $2,042. The next year went from 22.96 to 26.73, a pretty significant increase in dividend per share. 26.73 times 88.96 gives us 23.77. Let me just double check to see what the 26.73 times 88.96. Yeah. All right. So in that case, that's a pretty significant jump up. That's 26.73 minus 22.96. That's $3.77 in increase in dividends per share. Divided by 22.96, that's a 16.4% increase in dividend income. Not too shabby. Look at that. Then it went to 31.54 times 88.96. We made 28.05. But we're still $1,000 short of what we're getting the 10-year Treasury. All right, so let's just fast forward to here. At 2016, we finally broke what the 10-year Treasury is doing. We got $43.55 a share on the S&P 500, a doubling of what we were getting before, basically. So each share that we had, and we had 88.96 shares, we got $43.55. Times those two together, we got $3,874. Finally beating what we're getting on the Treasury. So fast forward down to the beginning of 2019, and we got $54.14 a share. Times by 88.96 shares, and we made $4,800, which is $1,000 more than we're getting the 10-year Treasury. Not too shabby. So a couple things to consider here, and I found this is going to be incredibly interesting. And I take my trusty calculator and I take my high-speed math stuff here. I say, okay, if we started with 22.24, and we go, that is our present value, that is our future value, 10 years. What is the rate of return on dividends? And the dividends grew at 9.3% a year on average. So the average increase in dividend and actual dividends was 9.3% a year, 9.3% increase. So what was 22.24 ended up at 54.14 over 10 years. That's 9.3% year over year on average is the increase in the amount of dividends the S&P 500 constituents paid. That's pretty doggone good. What was the increase here? Well, it's nothing. We got no increase. We literally got nothing. But we started off with a lot more. That's a fact. All right, so that's interesting too. Now, I don't have it written down here, but then I looked at the earnings growth, and just to give an example, and the earnings on the S&P 500 here was 54.29. So we had $54.29 per share. So 50, and maybe I'll do a different video on that. I think I will. I'll save that for a different video. But anyway, the earnings growth on the S&P 500 was 54.29 at the beginning of 2010. It ended the beginning of 2019. The earnings growth was 133.06. So the PE ratio at the beginning of 2010 was 20.72. I'm going to do a separate video on this alone because I think it's important. The PE ratio at the beginning of 2019, after we had that little bit of a fall in 2018 of about 5%, was 19.6. So we had no appreciation relative to earnings over the course of that 10 years. But earnings grew at 9.8%. 9.8% earnings growth. So earnings growth averaged 9.8, dividend yield averaged 9.3. Not dividend yield, dividend averaged 9.3. So according to the John Bogle, Jeremy Siegel, your old buddy Josh's ideas, we take earnings growth year over year plus dividend yield. And it's not quite, you can't really say dividend yield. That's not a dividend yield increase. It's a dividend growth increase, but either way, earnings growth year over year plus dividend growth, and we got that should be around about a 19% return in the S&P 500 over those 10 years, and it was about 13%. So these numbers overshot the S&P 500 in terms of the actual return performance of the S&P 500 for those 10-year times. I'll go into a whole different video about that, so don't get caught up. I want to focus on dividends. All right. So again, we made $33,059 in total income from the dividends over the course of that 10 years. We made $38,500 in total interest income from the 10-year Treasury. All right, I'm not even going to say what the value of the S&P 500 was. Just it won't matter because that has nothing to do with this. But the last year we made $4,800. The last year we made $3,800. Now let's go into the beginning of 2020. What do you think the dividend yield was on the S&P 500 on 1 January 2020? It was 58. I'm sorry, I went to get this other pen. You're using a bad pen! It's weird how 58.74. I don't understand why people get so weird, man. It's just strange. Like, dude, of all the things I worry about, my pen? Weird. What do you think the 10-year was on the 10-year Treasury at the beginning of 2020? 1.89. So here, 58.74 times the number of shares we have gives us an income of, I don't know, I haven't calculated that. So let's take a look at the income of that amount, 58.74 times 88.96. We're making $5,255 in income. 5,255. You know what we're making here? 1,890. This only thing this matters if the companies keep paying dividends. It doesn't matter what the share price is. It matters not. Now the companies might stop paying dividends. I don't know, but for them to have to go to pay the equivalent of the 10-year Treasury, they have to drop 66% roughly in dividend cutback. So 52.55. We'll just say times 0.4. No, not even that. They have to drop 52.55 by let's see, 52.55 by point. They'll have to drop 65%, 2/3 of the dividend payout on all the 500 constituents of the S&P 500, just to equal what this is doing here. Not only had that not happened hardly ever in the history of the S&P 500. It has. They've had, in 2008. But not only has it not gone down, it's actually gone up at a 9.3% clip since the last 10 years. That's insane. That's insane. Now, we can make all kinds of arguments. Well, 2008, a lot of banks were only paying a penny dividend to keep their preferred shareholders happy. There's all kinds of things we can say to justify this right here. But look at that dividend growth, i.e. the dividend growth fund from Vanguard. That's why I own that puppy, VDIGX, because the dividends are growing 9.3% just on the dividend growth. So if nothing else, regardless of the share price, you got a 9.3% annual appreciation in your dividend, in your dividends, in your cash. And that's not even reinvesting. If you reinvest it, it's just going to be even better because you're actually having more shares to get a higher income off your dividends. It's crazy. That is the power of dividends, man. And I will do another video, by the way, to show you the earnings growth year over year. And I'll show you. It's a what's the word? It's a monumental thing to understand the value of dividends. Now, that does not mean you buy a high-yielding stock because it has a high yield. I mean, just because it has a high yield doesn't mean it's a good buy. High yield means it has a low price. It might have a low price for a reason. But this is just the S&P 500, man. Now, you can also do what the dividend yield is. I mean, it's simple. You take the price, all right, it's 1124. You divide that by 22.24. So 22.24 divided by 1124. So the dividend yield here is 1.9. You see what I'm saying? So you take this, that's the dividend, the actual dollar amount, divided by the price, and you'll get the dividend yield. So let's see, the price in 2015 was 2028, 2028. Divide that into this, and we'll see what the dividend yield there was. 2028. Oh no, we got to go 39.9 divided by 2028. That's again 1.96%. So you can see it hasn't changed much. The yield was say 1.9% there. The yield hasn't done much, and we'll go here. The earnings, the price is 3278 at the beginning of this year, 2020. We'll divide 5874 by 3278. And that's a 1.79, so 1.8% dividend yield. So the dividend yield is irrelevant. I mean, that's what I'm trying to say. We had 1.9, 1.96, 1.79. The dividend yield isn't the driver. It's the consistent payment of dividends on an increasing earnings growth. Consistent payment of dividends, an increasing dividend payout, not the yield. The yield is secondary. Yield doesn't matter. It's the payout increase. $22 a share. $23 a share, $26 a share, $31, $35, $40, $43, $46, $49, $54, $59 is the increasing payout of the dividend, actual dividend you're getting. That's what matters. 1.9%, 1.96, 1.8. The yield doesn't matter. It's the increasing payout of the dividend itself, the dollar amount. Don't get suckered into thinking a high dividend yield is a good stock. That's irrelevant. Will the company be able to increase its dividend payout over year? That's what matters, because for long-term shareholders, that's all that matters. Anyway, I thought you'd find that of interest. I love this stuff, man. It's very, very interesting to me. Lots of value in the S&P 500. You're sitting right now at 58.74. I don't care if the market fell 13.3% this last week. It does not matter. I'm still getting that. In fact, if anything, that dividend yield, I don't know what the S&P is, the price. Well, what is it? I don't know. I can't. I'm using my phone for this video. But I can almost assure you that dividend yield is more than 1.8. The reason dividend yield is they haven't dropped the dividends. It's just they dropped the price of the S&P 500 because people have been selling it more than been buying it. So that means it's better now because the dividend yield is higher than what it was at the beginning of the year. It's irrelevant. It's completely irrelevant. So anyway, hope you like this. I'd love to hear your comments. Remember, dividends, man. Dividends. Those are your friends. A lot of people discount dividends. They say dividends are actually not efficient form of capital repatriation. I don't know what it is. So my man Meb Faber, he has written some stuff like dividends are not an efficient use to grow value. I get the argument there. It's a theoretical. I like numbers. I like dollar bills in my pocket where I can either reinvest in more shares or I can use it to spend. That's the only way to look at it. All right, we'll see you.